The Jared Dillian Show.
I'm Jared Dillian. This is the Jared Dillian Show. If you want to call in, please call 877-711-5211. I hate to do this. This is, we have to do it. There's no way around it. I know this is going to be, I don't want to say I want it to be fun. I don't want it to be tedious. I want it to be fun. I'm going to do my best to make it exciting, but we have to talk about bonds on the radio. And I know you're like, kill yourself. Let's start with stocks first. Do you own stocks? Yes or no? Okay. Stocks are pretty easy to understand. Stocks go up, stocks go down. You make money, you lose money. This is why everybody invests in stocks, because there's nothing exotic about them at all. They just, they're super easy. And you can own them directly in a brokerage account, or you can get a mutual fund. Most of you probably own stocks. I bet that most of you probably don't own bonds. What is a stock? A stock is shares of a company. It makes you an owner of the company. So Apple is this giant corporation. It's worth $1 trillion. And if you own 100 shares of Apple, you're an owner of Apple. And if you own something, you get to say what goes on there, sort of. So if they have a shareholder meeting and they have votes on stuff, then you get to vote. But it's not one man, one vote like democracy. It's $1, one vote. So people who have more shares of stock just get more votes than you. And if you have 100 shares of stock, you really don't have any say in what's going on. So you're just kind of passive. A bond is debt. You're making a loan to Apple. You're a creditor to Apple. And Apple, is going to pay you interest over time. And at the end of the bond, they're going to pay you your money back, theoretically. And they might not. They might default. Apple is a pretty stable company. They'll probably pay it back. But it's like making a loan. And the difference between a bond and a loan is that a bond, you can buy and sell and trade it like a stock. But a loan, you can't do that. It's just a loan. It's just a loan with a bank. So people think the stock market is like the most important thing in the world. The bond market is way bigger. A lot of people don't realize this. Bond market is way bigger and way more important. And people, if you turn on CNBC, you don't really hear a lot about the bond market. It's really more for retail investors. But, if you go to a bank, they care way more about the bond market. And even if you go to the local community bank, if you go to the local community bank, they have, they have somebody at the bank who's called an asset liability manager. And the bank has lots of loans outstanding, so they have interest rate risk. So they have somebody who actually hedges their interest rate risk in the markets. Even in your town, your little town, there's somebody that does this. They actually trade in the bond market. So back in 99, there was a big bubble in stocks. It blew up, and everything was fine. Back in 2008, there was a big bubble in bonds. It blew up, and it almost destroyed the planet. Bonds are way more dangerous. Debt is super, super dangerous. So when I first started investing back in 1997, even before I started reading books, I got this pamphlet somewhere, and I don't remember exactly the pamphlet. But the pamphlet said two things. And it said, if interest rates go down, bond prices go up. But it didn't say why. It just said, if interest rates go down, bond prices go up. And I was totally confused about that. And the other thing it said was, you should have bonds in your portfolio. But it didn't say why. So I was very confused as to all of this. I didn't know how bonds work, but they were telling me that I should have bonds in my portfolio. So I said, well, somebody's smarter than me. So when I built my portfolio, I put bonds in them. I took the advice. And I didn't really find out why I was supposed to do that until a few years later when I learned how bonds work in business school. Bonds aren't on CNBC because there's a fair amount of math involved. I was a math major in college. I understand the math perfectly fine, and I'm just gonna say it's not easy. And I teach, or I don't anymore, but I used to teach in college. and I would teach about finance, and I would teach about bonds, and I would teach the math, and people had a hard time with it. It's not easy. So I don't expect anybody to go learn the math in their spare time. We're not going to talk about the math on the air. It would be impossible. All I am saying is just pretend you're me in 1997 and somebody is saying to you, you need to own some bonds, and just take the advice because it's important, or you are going to be sorry. Let me tell you why. Generally speaking, if stocks go up, bonds go down, and if bonds go up, stocks go down. If the word for this is correlation, and they're negatively correlated. This is one goes up, the other one goes down. And what happens is that if you have a portfolio with stocks and bonds, if one thing goes up and the other thing goes down, that kind of cancels each other out. And what it does is it smooths out the volatility. So your portfolio becomes much more stable. So most people, they have a portfolio that's just all stocks, and it's super, super volatile. And then when it gets even more volatile, they freak out and they sell the stocks pretty much at the worst possible time. This has happened at many points in history, and this is the main reason why I tell people to add bonds to a portfolio, is to smooth out the volatility, because otherwise at some point they're going to have a heart attack, and it's not going to be good. And the practical, from a practical standpoint, investing in, you don't actually buy individual bonds. Bonds are an institutional market. Generally, it takes $100,000 to buy one bond. So most people don't buy individual bonds unless they're very wealthy. You buy bond funds. You buy bond mutual funds or ETFs. And that's how you get your exposure to bonds. The stock market is not that volatile right now. It's picking up a little bit, but overall it's not that volatile. Sometime in the future, it will be very volatile. If you go back to the financial crisis, 08, 09, there were days where the stock market was moving around 9% a day, up or down. So if you think about it, if you have a portfolio that's $100,000 and the market goes down 9% in a day, in one day you've gone from $100,000 to $91,000. Stocks have the potential to be very volatile, and people sort of have amnesia about how bad it can be, because it's been a while since it's been that bad. We had a little bit of volatility in the beginning of 2018, but not as much. But volatility, the purpose of volatility is to make you make bad financial decisions. That is the purpose of volatility. So let's define a term. Let's talk about drawdown. And drawdown is losses that you sustain from top to bottom. So in 2008, the stock market went down about 60%. So if you had $100,000 and you were 100% invested in stocks, you had $40,000, which is awful. If you take a 60% drawdown, I assure you, you are going to panic and freak out. What personal finance people like to tell you is the market will always go up. It always goes up. It always comes back. It always recovers. Just keep buying on the way down. And nobody can take that advice because it's too scary. It's too scary. If you have $100,000 and it turns into $40,000, what goes through your head is it's going to zero, and you will sell. And then, of course, it will go up, and then you're going to be stuck. So volatility makes people make stupid decisions, which is why you add bonds to your portfolio. If you had a portfolio of stocks and bonds in 2008, you would have only lost 24%. Much better than 60%. Are you going to freak out if you lose 24%? Well, you're not going to be happy, but that's not bad. I mean, if you consider that the financial crisis was the worst, like the worst crisis since the Great Depression, and maybe that happens one or two times in 100 years, and the worst that happens to you is that you're down 24%, that's not that bad. But people love their stocks. People are obsessed with the stock market, and people don't generally invest in what they don't understand. I told you in 1997 that I read that pamphlet on the bond market, and it told me to put bonds in my portfolio, and it didn't say why. And I was 22, 23 years old, so I just said okay, and I put bonds in my portfolio, and I just didn't try to grow a brain, And so don't try to grow a brain. And there's people out there who tell you that the stock market returns 12% a year and you should buy aggressive growth stocks all the time. And that is, unfortunately that has worked over the last 10 years, but that is not a sustainable strategy. You need to put yourself in a portfolio that you can live with in times of extreme volatility, or else you're going to puke it at the worst possible time, which is pretty much what happened to everybody in the financial crisis. I'm Jared Dillian. This is the Jared Dillian Show.
The Jared Dillian Show.
Hi, this is Jared Dillian. Catch the Jared Dillian Show from 6 to 8 Eastern only on the Smart Talk Radio Network.